Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
Eric, you know something that you know about is steak dinners. You like to make a lot of bets that involve steak dinners. We have a whole episode that is more or less about the steak dinner, only it's a different type of steak dinner.
Yeah, look, I mean, in the funds business for decades, there was, beating the market, there was low fees, and there was relationships. For a long time, they had loads where you literally paid a broker to put the client's money in the fund. And over the years, that became like seemingly expensive. But the idea of having relationships and wining and dining advisors and investors is one of the ways that you can actually sidestep the Vanguard effect. And no firm does it better than First Trust. There's a couple that do it, but I think First Trust is probably the best at it. And they're the sixth biggest ETF issuer, despite not really playing Vanguard's game.
Which is always of interest to us, as is the story that we're going to talk about on this episode, which caught our eye, about First Trust by Emily Grafeo and Max Abelson by Bloomberg Businessweek. So joining us on this episode, we've got Emily Grafeo, a cross-asset reporter for Bloomberg News, as well as Max Abelson, a finance reporter here at Bloomberg. This time on Trillions, First Trust. Emily, Max, welcome to Trillions.
It's an honor to be here.
Thanks for having us.
Okay, Emily, you report on ETFs, among other things. I'm curious how much you knew about First Trust before you started working on this story.
Well, what I knew about First Trust before I started working was I just looked at the data of comparing the largest ETF issuers and then their average expense ratios. So I knew that First Trust was the sixth largest issuer. I knew that they somewhat stayed under the radar. You go to ETF conferences. I never really noticed they were there. A lot of the other issuers have like big booths at these conferences. First Trust seemed to me to almost just stay in their own lane. They didn't market much to retail. You never really see a First Trust commercial like you do with some of these other issuers, like an Invesco QQQ ad. And so I knew that they were big. I knew that they were almost, you could call them quiet. And I knew that their average expense ratio was much higher than the top competitors when you look at the league table. And Bloomberg Intelligence actually had this report out estimating that they make almost as much revenue selling ETFs as Vanguard, but they're like 15 times smaller. So that data almost anomaly jumped out to me. And it was something that I know Bloomberg Intelligence had done a number of research reports on.
So a quiet but lucrative business model. It's also privately held. Jim Bowen is sort of the person in charge there, right? He's put together a little quiet empire. What do you know about Jim now that you've worked on the story? So
Jim Bowen has been at the helm of First Trust almost since the beginning. He became the CEO of the company pretty soon after the company started.
You know how in like White House presidential elections, there was, I don't think people talk about it anymore, but there was that old thing about like, do you want to have a beer with them? As a Wall Street reporter here, there's so many people who I write about who I would really not want to have a beer with. One thing I want to say about Jim Bowen is like, I would definitely have a beer with that guy. He seems very charismatic. He seems very proud of what he does. He seems to sort of cherish it. And his enthusiasm for his job made my job easier because it was fun to sort of behold someone and to chronicle someone who gets so worked up about what they do. So many people are like bored or just boring, and he's neither. He exudes this confidence and this sense of honor in what First Trust does. We help the financial advisor because the financial advisor helps the client, and we love that. And it was fun for me to understand what he meant and to like even do something as simple as like watching his speeches on YouTube.
Also worth mentioning that he did not participate, or neither did First Trust in the story. So Emily, break down a little bit about what you've learned about how the First Trust model works and how that's different than sort of maybe the rest of what has become the prevailing model in the ETF industry.
Right. So First Trust sells their funds. They pitch their funds directly to financial advisors who then select the funds for their end clients, which we're aware that a number of firms in the ETF industry do that, but their distribution model really stands out. They have what they call wholesalers, which are essentially salespeople that pitch the funds to the financial advisors. They have wholesalers all over the country who are assigned to small territories, think like just, one part of the southern US, to go out to financial advisors and pitch these funds. A lot of ETF companies, at least from my reporting, they'll have a wholesaler who maybe sells both mutual funds and ETFs, or they'll have a relatively small team. They're not really pushing the ETFs onto the financial advisors. One reason is because there's this saying, as I'm sure you guys know in the ETF world, ETFs are bought, not sold. So they're lower fee. That's really where the industry kind of competes. They have a lower fee fund. You market to a retail investor. A retail investor just wants to buy the cheapest fund out there. First Trust is different. They don't really play that low fee game. Instead, what they're doing is having these financial advisors who, from what I understand, are extremely knowledgeable. They pick up the phone when you have a question. If you're a financial advisor, they're there for you throughout the journey of owning this fund. And that's what we know about how their, distribution model is a little bit different from these other ETF companies.
Eric, when you break down sort of how that model works and what's in it for advisors who are getting pitched on products, how does that all fit together? This is a side of the industry that we actually don't talk about that much on the show.
Yeah, so advisors manage like $40 trillion of people's money in America. That's a lot of money. They're the gatekeepers of all that money. So, of course, they're getting pitched to constantly. Like if you're an advisor and you go to an ETF conference, you're like a rock star. You basically, everybody wants to,
I thought
sell
you
to
were
you.
the rock star.
No.
Okay.
Well, Richard Kang.
Eric is pretty famous at these conferences. If you walk with him at a conference, you can't walk 10 feet.
So I will get pitched for media attention. But I'm sorry, media attention is under asset allocation, okay? Yeah. So I know my place. So these advisors, RIAs up to big advisors, are really the sort of belle of the ball at these conferences. And a lot of them now, the sales, they don't really want to take calls. I mean, they're harder to sell to than ever. They don't have loads anymore. And so I think First Trust...
What's a load, by the way?
A load, again, is what I said earlier, which is where the fund has like a, let's say, 4.75% load where... Let's say it's a blank fund. I would then, the client would pay 4.75% of their own money that I would get, the broker, just for the luxury of putting you in this probably crap fund.
Like a handler fee.
Yeah. The whole mutual fund industry was built that way. It's almost like a bribe. And there's so much money sitting in bad funds because of it. Now, First Trust is a little bit of a throwback, but they don't do that. That is really 4.75%. It takes a long time to overcome that in performance. And the funds that they were putting those loads on were usually over 1% of an expense ratio, plus 1% trading fees, added up, and the investors barely get any of the returns over 30 years. This is what Bogle and Vanguard fought against. Now, First Trust is a little bit of a throwback, but they still are in the ETF business. Their funds are, 48 to 75 basis points, so they're definitely more expensive. The asset-weighted average fee of ETFs is 18 basis points. So they're above that, but they aren't beta. Like these are funds trying to outperform a little bit. They've got smart beta, active. They do a lot of strategies that are a little different. And I guess their pitch to the advisor is, look, you could do a Vanguard fund, but you do ours and you can have a chance to outperform. We're not that expensive. And, you like us. I mean, and I think part of the whining and dining is that just to tap that. So we wrote we were fascinated by this. And, we wrote a piece, I don't know, a couple of years ago, trying to explain where all flows come from. And we really got it down to the 3 C's, which is cheap, creative, or Cabernet. And and I'm not judging it. This is part of how funds and anything is sold. Like if you're in politics and you want another country to do something for you, you're going to have a dinner with them. You're going to go golfing. Like it's just an old school attempt. Now, a lot of the new issuers, what their move now is to do educational stuff like blog posts, and they have podcasts. It's more of like a soft sell. I think First Trust is just a little more of the old guard in terms of how they're selling their products.
Here we are, First Trust, we know, is wielding steak dinners. How is that influencing their business strategy, Max?
Okay, well, let me just say something about steak dinners, besides the fact that every now and then I myself enjoy a good steak dinner.
I probably owe you several, actually.
Actually, technically, you do owe me one. Thank you for bringing that up.
Okay.
You know, there is nothing wrong with a steak dinner. And in fact, there's nothing unusual about a steak dinner in finance. It would be really hard to try to find pieces of serious business on Wall Street or in financial capitalism that does not involve steak dinners of some kind. What is interesting and newsworthy about First Trust, according to emails we reviewed and interviews we did, is that in order to win business, First Trust has gone up to the line that's allowed by the financial industry's self-regulatory arm, which is called FINRA, and potentially crossed that line. Because what the industry will not let you do, Joel, if I'm the First Trust wholesaler and you're the financial advisor, I can't take you out to use a real example, a $300 hockey game and also $300 of food on top of that. I can't drop off a really nice meal for you and then bounce. I can't take you out for what would go beyond what the industry calls sort of Emily, what are those great words? It can't be neither extensive,
frequent, or extensive.
It can't be too frequent, and it can't be too extensive. And that makes sense.
Boy, that's a hazy line, though.
You know, I think that's actually a really fair point. That what we're talking about in this story, this is not a story of bright lines and obvious tomfoolery. This is a story about a gray area. The industry itself does not say, Eric, you can do this up to X plus 81. But if you do X plus 82, that's a problem. There is a certain kind of fog or haziness in the industry. And this story is not a story about First Trust, doing anything that's like, as we say, it's not like it's about buying a freezer full of steak. It's about the ways that First Trust, by its own account, according to one email we have, may have been getting up to that line or maybe potentially crossing it. And of course, we do have one email where a guy is saying, listen, pay to play is illegal and you all are doing it. So to the extent that there are some lines, pay to play is a clear line. And according to this one email, it was potentially being crossed.
Emily, FINRA is the regulatory agency that oversees a lot of this stuff. There's also an investigation into First Trust that you all report on. What do we know about that investigation?
Well, we know that the investigation is still ongoing as of right now, and it's been going on for at least a year now, that FINRA has been looking into First Trust's sales practices. So we don't know that many details, but we do know that there is an investigation. It's been going on for quite some time, and it's a little open-ended what will come of the investigation. We know that when it comes to pay to play, FINRA haven't really levied much fines on other firms. There's not much precedence for, a press release coming out that FINRA has investigated a company and they found instances of pay to play or instances of wining and dining that cross the line of what they would deem acceptable.
One of the things I noticed about covering First Trust also, besides some of the, interesting stories and their sort of relationship, assertive relationship sales tactics, is that they cover a part of the country that a lot of times gets left behind and not focused on. And I think you mentioned in your story, because I've always found that they really speak to the sort of Midwestern heartland of the country, whereas BlackRock and Vanguard are on the coast kind of. And I think that actually matters. If you're an advisor, you feel like they're just more connected to you both geographically and spiritually in a way. And I think that works for them to a degree.
I think that's a great point. We have a quote in the story, thanks to Emily's reporting, where someone who I believe is actually from Ohio himself talked about how meaningful it was that First Trust will go to you, They'll pay attention to you. They'll cater to you. They'll care about you. And I think that sense of caring came through in our reporting. First Trust, as far as I can tell, it's like they're not putting lip service into the idea that they like are really interested in what's happening in like exurban Cleveland. They seem to really go to the financial advisors there and help them and like think the work they do is honorable. And that's that's a pretty savvy move. I think I admire that.
And Jim Bowen is really boots on the ground. I mean, he is going to these various financial advisor conferences around the world and making speeches. And I'm not sure if you would see that with other, CEOs of giant ETF companies going to some conference that, maybe only a handful of financial advisors actually watch the panels.
Yet at the same time, he's rarely on TV. I mean, I don't think I've ever seen him on financial TV. I don't see him at the ETF conference. Like it seems like he's real more focused on just going right to the advisor in their space rather than doing it through mediums.
So what is he selling? What's in the portfolio? And what has performance been like, Emily?
So First Trust has over 100 ETFs. They have buffer ETFs. One of their biggest funds is a dividend index fund. So they have, I think Eric had mentioned, they have a lineup of, you could call them smart beta funds. They have their buffer funds. They have a handful of actively managed fixed income funds that have outperformed the ag for some time. They also have a crypto fund that did really well in 2024, outperforming some other crypto funds. So it's kind of a mixed bag, but you're not going to see a complete, like plain vanilla index tracking fund. Most of the funds have some type of smart indexing tilt to them. When it comes to performance, it's hard to measure, how does one ETF company, how does their performance stack up against the rest of the competition? Because as I mentioned, their funds are a little different than what you're going to get from a Vanguard or a BlackRock or even an Invesco, the other firms at the top of the league table. But when it comes to comparing First Trust performance, the funds were mediocre, pretty middle of the pack when you compare them to their Morningstar peers.
Yeah, and this is an important point because if you're an advisor and you are a fiduciary advisor, you could get into some hot water if you bought a First Trust ETF that was 50 basis points more than the Vanguard that did the same thing. That would be odd, and I would think you'd get some looks for that. But if you're buying something that has a lot of IP in it, it's an active management, there's a strategy, it's trying to beat the benchmark, then it could be the fiduciary move because you're paying for the IP. And I think First Trust case, again, to their credit, as somebody who covered mutual funds back in the day, you just wouldn't believe how much people used to pay between the loads and the fees that a First Trust Smart Beta ETF at 55 basis points or even 70 is within range of a fair deal versus what you used to get in some of these mutual funds. That said, somebody else might go, well, I can get a Vanguard dividend fund for 4 or 5 basis points. I don't need that. Well, the First Trust person would say, yeah, but we put a lot of secret sauce into the smart beta process in a way that, maybe it values certain stocks and this and that. And that secret sauce is, how much is that worth? Well, that's what people are struggling with right now in the ETF space. Capital Group, all these legacy asset manager coming into the ETF space, which I call the Terror Dome because it's so brutal. And they're trying to figure out, how can I sell this thing when everything's free? It's not easy. And so First Trust, in my opinion, has found a viable road in selling IP and, doing a lot of relationship management with it, keeping in touch with the advisor, being nice to them. And so we have studied them because honestly, they're like they're a model, I guess, of one way to fight the Vanguard effect. And when we write on the Bloomberg Terminal, a lot of our clients are scared of Vanguard. Let's just be, it's like Amazon coming to your little town. When you're a retail shop, like here's this shop that actually is still successful and profitable. How did it do it? So to me, First Trust has always been at least somewhat of a model for how to, live and survive and even thrive in the Vanguard era.
Is Terror Dome a reference to the third Mad Max with Tina.
That's
Tina Turner.
Thunderdome. No,
Ah.
I know the Terrordome reference is in you. It's
I'm
around the
thinking
same
of-
year.
Oh, Public Enemy.
Thank you. Yes. If you look at the lyrics of that song, that's what you feel when you launch an ETF.
This is the first time an exchange traded fund and Public Enemy were mentioned
Welcome to Trillions.
in the same minute.
Okay, Emily, I want to bring it back to some of the other reporting that you have in the story, because there's some interesting details that came out of divorce proceedings as well that really show how the company First Trust goes about entertaining, right? And that is the thing that has they've attempted to distinguish their business model with. So when you think about all of this and how they go about doing it, what are some of the things that stick out to you, and how will First Trust likely continue to distinguish itself in the marketplace?
This is a company that really puts an emphasis on the entertaining of these financial advisors. And there was an email that we uncovered where the wholesaler said we're expected to entertain. The company was built on entertaining. It was and still is the leg up on our competition. So that is really where they stand out.
You know, that reminds me, Emily, we have all these details in the story that are, I think, pretty fun and pretty eye-catching. $4,800 of Hermes scarves. Was it $70,000, Emily, at like a Ritz Carlton in Florida? The $300 hockey tickets and $300 on top. It reminds me that we're living in this current moment right now where I think there's a really big open question about the rules of the road for businesses, right? Which is a nice way of saying regulation, and the ways that those rules are going to be rolled back, which is a regular way of saying deregulation. And I think there's a world where a lot of the mores and the standards that guide how we operate in professional corporate America, a lot of those rules could potentially be changing, and some of those rules might be changing drastically.
Which makes this little hazy gray area all the more interesting. So, Emily, Max, thanks for joining us on Trillions.
Thank you so much. Loved it.
Thank you.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg Terminal, Bloomberg.com, Apple Podcasts, Spotify, or wherever else you'd like to listen. We'd love to hear from you. We're on Twitter. I'm at Joel Weber Show. He's at Eric Balchunas. This episode of Trillions was produced by Magnus Hendrickson. Bye.